What up, folks? It's your boy. I'm back. I'm here. Got some info for you. Hopefully, can add some value to your situation. Just feeling a little silly right now, but I want you to go ahead and do me a favor, like and subscribe. You know that's going to be valuable. That's the reason why you're back, and I greatly appreciate you. So once again, it's Kenneth here with 100 Years of Wealth, streamhomeloan.com. I want to make a quick video regarding, it's really going to be more mortgage loan officer specific. Right now, our industry, we have seen an uptick in interest rates from the start of the year till now that has just continued to push us into a realm where rates have been, almost doubled in a lot of scenarios, from rates that were in the 3% range to now where we're seeing interest rates in the 6% range. So my company, we have loan officers that work independently trying to generate their own business, and what they're seeing out there is a significant slow in refinance transactions. If you don't know, refinance transactions means someone currently has a loan and they're looking to better the terms on that loan in some way, shape, or form. Usually it's by lowering the interest rate, removing private mortgage insurance if they had PMI, private mortgage insurance on their loan, and also a lot of people look to take cash out through a refinance transaction. But when you have a market where the rates have ticked up so significantly in a short amount of time, most of the current homeowners or people that have loans have probably refinanced in the previous few years to where they are at what would be considered the market rate or the previous market rates of those, 3%, sometimes even lower in the 2% range, sometimes even lower than that. We've seen 10-year and 15-year fixed rates at 1.875, 1.99% last year, and maybe as late as like January before things start to really shift. So what happens is that when the rates jump up significantly, it just removes a lot of benefit for a lot of people. If you already have a decent interest rate, unless you're desperate and strapped for cash, you're probably not going to look to refinance that loan for, there's no reason, right? There's no reason if you're just looking at a scenario where you're looking to just better your interest rate. So we're seeing that a lot of the production that's happening right now in the industry is going to be purchase business, new people or new purchases of new homes. People that are going into a scenario not trying to better a current loan situation, just more or less trying to figure out what works for them to get into that property. And in those scenarios, people are more payment driven and less really attached to the interest rate. Obviously, rates going up will increase payments for people, but when people can still find an affordable payment on a purchase scenario, they tend to, move forward. But this video is about refinancing and why people still do refinance even if the rates are higher, even if the market's jumped up. There are people out there still refinancing. And I think it's beneficial in a market that is quote unquote a purchase market to really focus on the side of the business that is really thriving, which is the purchase market. And the way that you take advantage of that is through meeting realtors, through advertising to people that are renting, things like that. But I just wanted to make this video to let people know that are looking at refinance business, that are still trying to find clients to refinance. There's deals happening. You just have to understand why those deals are happening so that you can change your approach from an approach where it's like mainly focused on interest rates to an approach that understands the other benefits that are out there. So I'm going to make this quick, just give you a short rundown of the different ways that you can still find clients or still help clients that are looking to refinance. So one reason why someone would still refinance right now, even though maybe they have a lower interest rate, is because that interest rate might be an adjustable rate, meaning that in the near future, that rate is likely to adjust or it's already adjusting. And in a higher rate market, an adjustable rate creates a lot of volatility for a customer, a lot of uncertainty. So most people are going to want to veer towards a secure rate. And they've probably been in like a period of security where maybe it's been a 5-year fixed rate and now it's about to adjust or go into the adjustable rate mortgage. So You want to consider the fact that, hey, you might have a client that says, I have a 2.75% interest rate or a 3% interest rate. What can you do to help me? And if your mentality is like, oh, that rate's low already, there's nothing I can do, they're going to sense that you probably will end up going your separate ways. But if you dig a little further and you ask them why, they're looking to refinance at, a low rate, or you can kind of assume that the reason you can assume that there is some sort of benefit out there that they're trying to search for, and obviously that low interest rate isn't accomplishing that for them. So that's where you would probe a little further and find out if that reason is because, for one, it is an adjustable rate that they want to get back into a secured interest rate. So that's number one. That's the number one reason, or I won't say the number one like that's in a ranking, but that's reason number one that someone may want to refinance even if they have a lower interest rate. That rate might be an adjustable, and it might be going into a variable stage pretty soon, which can put them in a higher rate than maybe you can actually offer them, or just puts them in a variable situation where they're not as comfortable because they don't have a set payment that they can count on. So number one, variable rate. Within that, you also have scenarios that are balloon payment, meaning that at the end of a certain period of time, that loan is just going to come due. They're going to have to pay off the full balance. Usually people accomplish that through a refinance. So you might have someone that actually has a pretty low interest rate still. Maybe that rate's been locked in, fixed for a certain period of time, but the whole time it's been an interest-only payment. So you end up having a balloon payment or a time frame where that balance needs to be paid off in full. That would be another reason, kind of within the realm of an adjustable rate mortgage or an adjustable term, that someone would want to refinance out of their lower interest rate. Another reason is because they have to. Maybe they're in a situation where they are getting divorced, and that loan is between them and their spouse currently, and now they need to go their separate ways. Someone needs to be paid out through getting some cash out of the equity, etc. But divorce is a common reason why you'll see someone needing to refinance, and their current rate isn't a factor at all, because they're really looking at what's the best I can do in this situation that allows us to basically follow the order of the divorce decree and separate, and one person take on the loan, or basically usually it's going to be one person's going to keep the loan or keep the home while the other person parts ways with a little bit of cash out. So divorce is a reason why people will need to refinance and why their interest rate won't really matter. Obviously the future rate and affordability is going to matter, but that current interest rate being low isn't going to be a factor because they have to do this transaction. Cash out needs, right? So like, obviously if someone has a low interest rate, that's attractive, but if they do a cash out loan where they're going to be paying off other debt, you could make it to where, maybe they have a 3% now, and you're going to give them a 4.5%, 5% interest rate, but maybe the payment is $1,000 less because you're consolidating a car loan, you're consolidating some sort of high interest revolving credit card debt, or some sort of high interest installment debt. That's a reason why someone might say, hey, you know what? I'm okay with letting go of this 3% interest rate to gain the benefit of paying off all that other debt, because I'm, right to my limit as far as my monthly expenses. So debt consolidation. Another form of cash out, or another cash out purpose that would, kind of make it to where, someone's highly incentivized to do the transaction, is either emergency situation, something's come up and they have to look for some place to pull some cash from, and usually someone's home is going to be probably their own, unless they're sitting on a bunch of reserves, probably going to be their only or most ideal place to borrow funds from. So a cash out emergency situation could put someone in a position where their current rate isn't as much of the factor, and it's really about affordability. My daughter just graduated college, and right before she graduated, she had to pay for an additional class. Forgot exactly the full scenario, but I quickly had to come up with some cash. If I didn't have that cash, I would have probably looked to refinance and pull out a little money. So cash for college A lot of parents out there, a lot of people have students going to school, and where are they going to pull 25, 30, 10, 15, whatever amount of cash from at a low, simple interest? Usually it's going to be your home. It's always going to be probably a more affordable route or a less expensive route than taking out a student loan, where the interest rates are traditionally much higher than on a simple interest mortgage loan. So these are the expenses that they have to do. Like when it's that time when the person's like, I need 20K for for college, or we had this emergency pop up, I need 20K for that. There's not really an option to say, well, we'll pass on that. They're gonna say, okay, what's the most affordable route to do that? And they need you on the other end, not being rate sensitive, showing them ways to kind of offset that higher interest, and also just really displaying the benefit of getting the cash out or getting, accessing those funds at that time. So we went down college, home improvements, some sort of emergency need for cash. Debt consolidation is going to be one of the more common reasons why someone refinances and says, I'm okay with going to a higher interest rate because I'm going to save a bunch of money on a monthly basis through paying off these other high interest revolving credit card debt. So what else? What's the other reason? There's another reason. Another reason why someone might be comfortable or okay with moving away from a low interest rate loan and going into the higher rate that you're offering is going to be payment relief, right? Over the last, 10, 15, or I don't want to say 10, 5 years or so, some of the lowest rates that were out there were on shorter term loans, 10-year fixed loans, 15-year fixed loans, right? So you have like a 30-year amortized loan, meaning that the payment's going to be stretched over 360 months, which is 30 years, and you'll have a rate associated with that. Now, a lender will give you a lower interest rate if your term is shorter. So usually you go down to a 20-year term, you get a little bit of a better rate. You go down to a 15-year term, you get a lot better interest rate. You go down to a 10-year, your rate even gets better, right? But you're consolidating that 360 months of payments on a 30-year fix down to 180 payments on a 15-year or 120 on a 10-year. So your payment's gonna, naturally jump up. Your payment's gonna significantly go up if you're consolidating your loan down that, that much from like a 30-year to even a 20-year, or, like I said, to a 15 or a 10-year. Your payment will jump up. What I've seen in the past is people will do that and then later on realize, ooh, that payment was a little bit higher than I wanted. Let me stretch this back out to a 30-year term. And that can happen. That could be more common with someone that has like a fluctuating income. Maybe they're self-employed, maybe they're in sales, and they're, at a time where they were really having a lot of production. They were okay with consolidating their loan with the idea of paying it off, and they were okay with that higher payment. But then fast forward, numbers change. They want to lower their monthly expense. They can use that cash, or they could benefit from having additional cash flow. Those are the scenarios where someone might say, okay, hey, you know what? We had that 15-year fix. It was working for a while. Let me go ahead and refinance to a 30-year loan. I'm okay with taking a higher interest rate because my payment's going to be amortized over such a longer period of time. I'll see a big decrease in my monthly payment. And maybe in the future, if rates drop, I can refinance. But those are the reasons, my people. Those are the reasons you should always keep an open mind when you're talking to someone that may even have a lower interest rate than what you can offer, or even just something that is just way reflective of the market last year. That's okay. They are obviously searching for something. A lot of times people want to hold on to that interest rate and act as if they don't need something, act like they don't need lower payments, act like they don't need cash out. But it's our job to say, hey, you know what? I totally get that you have a great interest rate, but I can probably save you $1,000 a month by paying off your credit cards. And then you can take a few $100s of that, throw it back at your mortgage and offset that interest so that your effective interest rate is lower, right? We have to be creative and not so rate sensitive and think that rate is the only benefit, because that's just one component of the scenario, right? Like if it was all about rate, then everyone would go with a 10-year fixed loan, because that's going to give you the lowest fixed interest rate. But clearly it's not all about interest rates, so people go with a 30-year fix that has a higher interest rate, and the reason is because it gives them a better payment, right? So I'm just saying, in a scenario where you compare apples to apples, no, the reality of it is that people want the best rate that they can get for the scenario that's the most beneficial for them. If they don't have the understanding to really kind of look at the different scenarios and weigh it out and see how they are benefiting, then they're really just going to attach to the interest rate, because that's just what the common consumer is going to do. That's what they're sold regarding mortgage regarding mortgage loans. It's the rate that you should look at. But what I find is that my more savvy clients, and I don't want to just say savvy, but your clients that have a little bit more financial experience, maybe they have a little bit more funds available, they are usually going to be geared towards the payment, or they're more accepting of a little bit of a higher interest rate when it gets what they're looking to get done. When it accomplishes their goal, they're like, it is what it is. I'm looking for cash flow right now, so I'm okay with taking a little bit of a higher rate that gives me that cash flow. And I think that other clients can understand that too. It's just really about articulating that to them. And it's not always going to be the best scenario for them to go to a higher interest rate to try to achieve some of their goal, but sometimes it will be. I think that it's up to us to really kind of articulate that, spell it out for them, give them some different options, get creative with amortization tables, letting them know ways to pay their loan off quicker, even at a higher interest rate, which will offset the amount of interest they pay, therefore effectively giving them a lower interest rate. So if you're in my company, I've already sent you some amortization tables that show you, hey, if you pay an additional $100 towards your monthly payment every month, this is what it does over the life of the loan. And that's a way for you to really put numbers together and show your clients how to offset the higher interest rate that they're taking, because it is something that is to a certain degree in their control. So right now, there's business still happening. You can still get refinances done. There are still clients out there that need to refinance. Be that agent that can help them out. Don't be rate sensitive. Look for the benefit. Look for ways to better their situation. And when we're talking about a mortgage, it just comes down to dollars and cents. People are looking to increase their cash flow and increase their monthly comfort. And sometimes in order to do that, you gotta refinance your low rate into a scenario where you can pay off some debt, where you can take some cash out, put money in the bank as reserves, do the home improvements that you want without tapping into your own cash, things like that. So keep that in mind. Like, subscribe, share this with a loan officer that needs it, share it with someone else that, may not be a loan officer that needs this information, but I hope all is well with you guys. Stay safe, stay healthy, 100 years of wealth to you and yours, and let's keep it rolling. Thank you.